9, and as Arsalan also discussed earlier, the most critical matter which desire extraordinary attention from the auditor side in IFRS 9 are the transition triggers, which is the transfer of portfolio from stage 1 to stage 2. This is the most critical area where the auditors need to pay more attention in terms of applying the audit procedures. The second biggest aspect which is going to change in the IFRS 9 is the methodology and approach to work out the expected credit loss model. And when we talk about the methodology and approach to work out the expected credit losses model, I think one of the key factors for this will be the determination of the PDs. And when I say PDs, it is the 12 months PDs and at the same time the expected loss PDs. So these are the two major criteria from the auditor's perspective, which actually requires more attention from the auditor side. I'll give you some indicators which will actually help the auditor in order to determine that what are the factors which will occur that will actually qualify that criteria for transfer of loan provision from stage 1 to stage 2 for calculation of the lifetime expected loss. And these are some of the qualitative and quantitative factors. I think one of the important factor is the point number 3, which is the change in external market indicators. If you look at the point number 4, which is actual or expected change in the external credit rating, these are the two major factors in order to transfer the portfolio from stage 1 to stage 2. Actual or expected change in internal credit rating and behavioral scorecard, because most of the banks are actually preparing their ORR rating internally at the time of disbursement of loan, and at the same time they review the ORR ratings annually at the end of each cycle. So change in the ORR category of the loan from say for instance category 2 to category 7, category 7 to category 9 may qualify the transfer of loan from stage 1 to stage 2. Existing or forecast adverse changes in the business or financial economic condition, actual or expected significant change in operating results of the borrower, significant increase in credit risk on other instruments of the same borrower, change in regulatory or economic or technological environment of the borrower, change in collateral value. This is very important, because if you have customers and you have taken the collateral value which is actually fluctuating, so the change in collateral value may trigger the transfer of portfolio from stage 1 to stage 2, quality of guarantee provided by the borrower, reduction in financial support from the parent entity or credit enhancement and quality. In IFRS 9, there is a presumption that if the customer is not paying within a period of 30 days, there is a presumption of transfer of portfolio from stage 1 to stage 2, unless based on circumstances, based on the governance structure, based on the policy document, you rebut it. So 30 days DPD overdue normally qualifies transfer of portfolio from stage 1 to stage 2, unless you rebut it somehow that these portfolio should not be transferred from stage 1 to stage 2. The second biggest change in the impairment testing methodology is the readiness towards the impairment credit model. This is one of the biggest preparation exercise for the clients, for the auditors, because the credit model preparation, if you are, like say, following the Basel II approaches, I think it may not take much time. But if you are starting your entire process from scratch, considering that if you are following the standardized approach, I think this will take a lot of time. So I have highlighted few of the model consideration that you will consider while preparing your IFRS 9 model. I think one of the major criteria in the preparation of the model is the judgment required at the time of preparation of the model. And when I say judgment required for the preparation of the model, it means that what methodologies you are going to apply in order to arrive at the expected loss provision or the 12 months PDs. The second biggest challenge for the banks in Pakistan, I think, is the data, because in some cases the data actually exists but need to be refined. But in some cases, data does not exist and needs to be captured, and in some cases, data that needs to be developed. The third major consideration is the alignment of credit model with the regulatory Basel reporting model. As Arsalan highlighted, that there are few differences in Basel approaches and the IFRS 9 approaches. If you are following the standardized approach for the capital risk charge on the credit risk assets, the data which you have available for the standardized approach may not be useful to implement the requirements of IFRS 9. But if you are following the internal IRB approach or the advanced approaches, so in some cases, the data you are actually incorporating in your Basel model may be used by the banks for the IFRS 9 requirement with certain significant adjustments. And what are those significant adjustments? Because in Basel, there is a specific definition of default, which is 90 days. But in IFRS 9, the definition of default, particularly for transfer of portfolio from stage 1 to stage 2, is set at 30 days unless you rebut it. So there is a difference between the definition of default under Basel and under IFRS 9. For the transition rule under Basel, your loan cycle is normally for the retail customer is 5 years. But under IFRS 9, there is, for the determination of PD, you have a specific criteria for the 12 months and the lifetime PDs. For the corporate customers, again, in the Basel, you have a time horizon of 7 years in order to determine the PDs. But in IFRS 9, you have a specific criteria of lifetime credit losses. So there is a difference between the Basel approaches and the IFRS 9 approaches. But if the banks are actually using the advanced approaches for the model, so the data they have captured for the preparation of the Basel II model, it may be used in the IFRS 9 provision methodology, but with certain significant adjustments. I think estimation of forward-looking losses, this is one of the complex area, because estimation of forward-looking losses will entirely be based on the macroeconomics indicator. If you look at the Pakistan, you have certain set of information available right now. You have GDP rates, you have inflation rates, you have some of the sector analysis. But in most of the cases, if you are applying the principle of IFRS 9 in the credit modeling for the segmentation of portfolio, and if you have two portfolios, one is textile and one is auto, so in some of the cases, the macroeconomic indicators for the auto sector and for the textile sector may not be available on a timely basis. So this is one of the biggest challenge for the clients while preparing the credit model, and at the same time for the auditors to make sure that the assumption, the comprehensive set of assumptions which are actually required to incorporate in the credit model are available or not. I think specific issues relating to certain key portfolio. If you look at the Pakistan banking portfolio, you have one of the major challenge for the IPPs in public sector debt. The contractual maturity of the public sector debt is well defined under the contract, but in sometimes these contracts are rollover by the government. So in the context of the IFRS 9, you may have a challenge at what would be the PD for that portfolio, whether this portfolio will qualify for the classification under stage 1 and under stage 2, and what is the criteria based on which you will review that this portfolio will not qualify transfer from stage 1 and stage 2. Time frame. I think this is one of the important area from the implementation of IFRS 9 perspective. Most of the projects in the international market, as Arsalan highlighted, they have started the implementation of IFRS requirements 1 year back. In majority of the UAE market, the Central Bank of UAE has issued instructions to most of the banks to start doing the gap analysis to identify the major gaps in the policies, procedures, governance, models, information capturing exercise. And the UAE banks have been instructed by the Central Bank of UAE to present a proper comprehensive gap report in order to remediate the gaps identified in the implementation of IFRS 9 in next 2 years. At the same time, the Central Bank of Bahrain, they have also issued the similar instructions to the bank to submit a gap report to the regulators in order to identify the comprehensive gap inventory. In my view, the time frame for the implementation of IFRS 9 is extremely important. These are some of the practical challenges, particularly relating to the Pakistan banking industry. We already talked about the issues of the data availability, data segmentation and data cleaning, because some of the banks so far not yet installed and started projects on the data banks. So I think this is one of the practical challenge for the Pakistan banking industry. Estimation of LGD in Pakistan, if you look at the credit proposal of most of the banks, they are taking the benefits of the forced sales valuation, and at the same time when they are disbursing the loan, some of the loans are based on the hypothecation and charges and forced sales value of the collaterals. In Pakistan banking environment, because I was working on one of the bank, the realizability rate of these collaterals and the recoveries from the customer is one of the challenging area. So from the perspective of IFRS 9, I think one of the biggest challenge for the client, for the auditors, is to determine the right calculations of the LGDs while calculating the expected credit losses model. Fluctuation in forward-looking assumption. If you have fluctuation in the forward-looking assumption, you will have varying degree of PDs for 12 months and expected credit losses model. Timely availability of forward-looking assumption. I think this is one of the major challenging area for the banks while they'll be preparing the credit model, because most of the industry-specific macroeconomic indicators are not available, or if they are available, they are not available on timely basis. Assigning value to revocable credits. This is one of the challenging area in IFRS 9, particularly in case of running finance facilities for the other rollover credits. Estimation of individual feature cash flows if you are grouping your financial assets on an individual basis. Particularly for the commercial customers, we have large portion of unrated customers. So this is the biggest challenging area, that how you are going to determine the PDs and LGDs for the specific unrated customers. Impairment methodology. Presently, internationally for the credit modeling, we have defined set of methodologies for the roll rate, vintage and migration. It all depends that the bank A is using methodology X and bank B is using the methodology Y. So the consistency between the bank A and bank B as far as the impairment methodology is concerned will be a challenging area. Industry consistency in determining credit losses. This is again one of the challenging area, and robustness of the current credit model. So these are the specific set of assumptions, particularly in case of Pakistan banking scenario. This is a very broad roadmap for the requirement, for the implementation of requirements of IFRS 9. I think if the banks wishes to if the bank wish to implement the requirement of IFRS 9, they first need to set up the governance and policy review structure in the banking environment. That is the stage 1, review of data and architecture system, the amendments in the process and policy and procedures. This is one of the major area that require attention from the bank side. Then the development of the impairment model, data and system. The last bucket, which is the stage 3 bucket, it's about the parallel run, organizational structural review, training, change management program, and the early involvement of the audit and regulators. This is a broad roadmap for the implementation requirements of IFRS 9. We have been discussing the IFRS 9 implementation challenges with our network team who have first hand-on experience of dealing with the IFRS implementation requirement, and we asked them certain set of specific questions, and I'm going to share the responses of the international teams on the implementation requirement of IFRS 9. We asked them that who will be the most influential when interpreting the requirements of IFRS 9 for implementation, and the response was that the central bank and the auditors. The most important factor for the implementation requirement of IFRS 9 as far as the significant deterioration in the credit quality is concerned, they say that the missed payment for retail and risk changes for the corporate and SME customer. IFRS 9 states the default definition should be aligned with an entity credit risk management practices. We asked them that do they think that the competitor bank will define the default in the comparable manner. They say yes, but majority of the definition in the international territories, the default definition is coming from the regulators. So for event of default, particularly in case of corporate and commercial customer, for retail customer, there are few rebuttable presumptions in IFRS 9, but in most of the cases, in most of the territory, the definition of default is actually coming from the regulator. In terms of impairment model development, we asked them that which option best describe the delivery approach, either to build a new model altogether under IFRS 9, or leverage the existing model under IAS 39, or leverage existing model used for Basel purposes. So everybody said, because in the sophisticated economies, they are using the advanced approaches of the Basel II requirements. So they said the existing model for Basel will play a major role in terms of build-up of the credit modeling methodologies. In terms of priority, we asked them which factor do you see the biggest model challenge. They say for the preparation of the model, the biggest challenge for the clients and is the data needs.